Now, our next guest expects to see an upswing in deal-making. He says M&A activity still is anemic by historic standards, but we are starting to see signs of life. Fred Lane is the vice chairman of investment banking at Raymond James. He previously was the co-head of DLJ's M&A department. He joins us from our Boston newsroom. Fred, thanks for coming on the show. Let me ask you, obviously today we have a couple of big deals. I think it's the 7th biggest Monday for M&A activity this year. But do you see a trend starting to ramp up here?
Well, I think we're seeing some improvement. Clearly, these deals, looked at through the lens of 2 years ago, are pretty small potatoes deals. But $5.5 billion deals and $4.5 billion deals, that's starting to sound like real money to us who have gone through a period of 12 to 18 months where the activity has been absolutely anemic, and that's probably a euphemism for something far worse than that. There was a period going back starting in last fall up until late spring this year where basically there was virtually no deal activity. Obviously there were some, but I think the climate has improved a lot, and the reason the climate has improved a lot, I think, is reflected really in the strength of the credit markets. The credit markets have opened up again. They're not as strong as we'd like them to be, but then again, we probably could do without the excesses of 2005 and 2006 as well.
Hey, Fred, do you feel like there's a lot of companies just sitting on the sideline just waiting to do a deal at this point, that they've got the cash in hand, but they're just kind of waiting to maybe ride out the economic environment just a little bit more?
I certainly do, and I do think there's a certain degree of deals begetting deals. I think deal activity tends to alert boards of directors and managements to the fact that deals can get done. And I think sellers have somewhat capitulated with respect to price and value, and I think there'll be certain sectors where you're going to see deal activity. We're in an economy, an economic part of the cycle where top-line growth is hard to achieve, and so accordingly, I think one of the great ways to grow, and particularly in an environment like this, is the stronger going to get stronger.
Fred, hold on. We're going to come back and talk some more. We're talking with Fred Lane of Raymond James.
Quick break, and we'll see if deals are getting bigger. Are the premiums getting smaller, though? Stay with us. We're back in 2. All right, Fred Lane, we're going to welcome him back from Raymond James to talk more about M&A. And Fred, you'd say that the deal size is getting bigger, at least this deal is a little bit bigger. I noticed, though, that the premiums look like they're coming down if you graph them. Have you noticed premiums getting smaller?
I think it's natural that premiums will come down in a rising stock market. There was a time back in the 70s and the 80s where a typical premium was 40 or 50%, and that was a time, and by the way, I was around in that period.
Lucky you.
Yeah, lucky me, the dinosaur in the industry. And when values are very low, justifiable premiums can expand quite a bit. During the 2005-2006 era, it wasn't at all unusual to see 20 and 25% premiums, and I think we're going to see some reduction in premiums, but so much of this is deal specific. We don't really have a lot of data, quite honestly, versus a more normal, buoyant M&A environment to really look at premiums in a really valuable way. But I think premiums are going to come down as stock prices go up. No question about that.
Fred, is it all about strategic deals at this point? I mean, we don't see a lot of hostile activity happening. Does that make sense in this environment as well?
I think there are two things. One is we don't see a lot of hostile activity, in part because lenders aren't willing to go way out on a limb in terms of providing the leverage necessary. Obviously, if a company has a very deep pocket and is investment grade, they can go after a company on a hostile basis. But then again, you have to feel very comfortable. You understand the underlying dynamics in that market. I think we'll see some of that. But I think the other glaring omission here in terms of deal activity is the private equity community has generally been very quiet. And the private equity community, who are still sitting on hundreds of billions of capital, will come back into the market. But the other side of it is they are also starting to selectively bring properties to market, because they have holding period constraints. They have limited partners who want to see returns on capital. Many of them have needs to raise additional funds, and they need to show realized gains to the limited partner investors.
I wonder what you think about valuations here, because we've obviously come down a lot from the highs of 2007 when we saw a lot more M&A activity. Are we looking at lower valuations, because still the S&P PE is at 19?
I think a lot of this has to do with demographics and other asset classes competing for returns. I actually think valuations here are pretty full, but I think they will remain full by at least the standards of the 70s and the 80s because there's so much liquidity in the system. Let's remember that the aging baby boomer that demographic has to invest. And where they invest and how they invest will be determined by what's happening with various asset classes. In the last 12 months, the place to be has been high-grade bonds, quite honestly. You're looking at 16 to 17% returns. But I do think that valuations won't come down a lot from here. But we're going to have a pretty weak economy going forward here, so I don't think earnings are going to be very strong over the next 12 to 24 months. So I wouldn't expect that PEs are going to expand from this level either.
Hey, Fred, 10 seconds left. Just real quickly, where do you think is going to be the hottest area for any kind of M&A activity? And just quickly, if you could.
Well, I think the media space. And I think the media space because we all are living through an incredible revolution in terms of how media is distributed.
Right.
And there are two kind of and the Disney Marvel deal typifies it: intellectual property and distribution.
Got it. Fred, thank you so much. Fred Lane of Raymond James.